Hey, this is Darren from Property Prosperity. Today I thought I'd have a bit of a chat about trying to get finance if we're self-employed. First thing to probably understand is, I don't know if you're self-employed, but if you're not self-employed, you might not necessarily know what that means. And there's varying degrees of self-employed. So some people are what's called, subcontractors. So they might be like a tradie and they work for the same company. And essentially the business they work for has outsourced a lot of the, as far as they're concerned, the liability and responsibilities of hiring an employee, so they don't pay you sick pay and holiday pay and a whole pile of other entitlements, your super and all the other sort of stuff. So they look at that as a cost saving, and so in that case you've basically got one source of income, and so or otherwise you might be self-employed where you have a whole pile of different sources of income. So you might might be a tradie where you do work for lots of different people. In that case, you have lots of different customers, and so your income's not as reliable as if you had one source of income as a subcontractor. So it is slightly different as far as the bank's concerned, and there is some different things to consider as far as that goes. And the other option as far as self-employed is you might actually be running a proper business, which means that you have staff working for you and have overheads and offices and stock and a whole pile of different things. So that's slightly different again too. So the banks will look at you slightly different. Hey Mike, thanks for joining me. They will look at you slightly different depending on what your situation is. The first thing to understand, you've probably seen a lot of advertising about banks out there saying, hey, if you're a small business, we are out there trying to help you and we want to put out loans to lots of people in the small business industry. So thanks for the like, Mike. So the first thing to understand about how banks make their money is obviously they borrow money and they lend it back to you. So they borrow money at very, very low rates at the moment, particularly because the interest rates are historically crazy low. And then they add a markup onto that and they rent it back out. Oh, I don't know if you know, but they've basically been having, every year they've been making record profits. So they've been doing pretty well with the banks, and obviously they're crying poor every single year. And during the GFC, they particularly got very loud with their suggestions that they were all going to go broke. And so what happens? The government came in and they backed the banks, saying that, hey, if anything happens with you, we're going to cover you. And so what that meant, they could still borrow rates particularly low, but the interest rates went up higher, so they were making even more record profits during the GFC. That allowed them. They had essentially an unfair advantage compared to the non-banks, because they were the government was only backing the big four banks. So all the non-banks then were really struggling because they were borrowing at a lot higher rates and they had to try and compete against the banks. Essentially what that meant was most of the non-banks got into real financial strife. Because the big banks were making so much money, they essentially went and bought out a lot of the non-banks, so that reduced a lot of the competition in the market. So that put them in a really powerful position that they bought most of their competitors and they had control of the market. And what that essentially means is they didn't really have to compete too hard with anybody except themselves, the big four really. Because the majority of loans are going out to, mums and dads and home lending, they had to try a little bit harder in that market. But in the world of, hey, thanks for joining, in the world of business lending, they knew they could take advantage of the situation to a degree more. And so you'd find in the world of business lending, they were a lot more risk averse, which means they were basically charging a lot higher interest rates for business lending. They were still borrowing at the same rates, but they were just charging a lot more money to lend it out to business. So they were finding they were making, a lot of these record profits they continue to make every year on year on year is coming from business lending as well as from credit card, because, people are still getting charged 20% on their credit card when, they're borrowing the money at, 2%. So it's pretty crazy how much money they're making out of credit cards. And likewise with commercial lending or to business lending, they might be charging 8, 9, 10, 11, 12% when they're only borrowing the money at say, 2%. So because they were making so crazy profits on this sort of type of lending, they're actually, you'll find them out there targeting, small business lending. And so the thing to understand when banks are out there saying we're out there to help you, they're out there to help themselves and they're out there to make lots of money. So that's the first thing to understand is that, the banks are, thanks Mike, yep, that's it. The banks are out there to make money and that's essentially all they care about is making money for themselves. So again, my first advice to you is shop around, try and look around for the best deal. Unfortunately, because of the way the GFC worked out, the the big four banks had a massive control over the market. They then bought out all the little banks anyway, and so it's pretty hard to go to someone that's not one of the big four banks, to be honest, because essentially they control the market really. So, but still shop around, because you'll find, particularly if you go to a mortgage broker, they'll shop around. Even if you go to some of the smaller banks, which are owned by the big banks anyway, you'll find they've probably got better fees and better charges and all that sort of stuff than the big four banks. Even if they're owned by the big four banks, because they know if you're going to shop around, they want to make sure they don't miss out on some of the money, even if it's going to be slightly lower rates and fees and charges and stuff. So they don't really want to compete against themselves, because they know if you're going to go to the big four banks that you're going to pay more. So yeah, that seems a little bit crazy, but essentially, whichever way you go, you're probably the money's going to get back to one of the big four banks, which is frustrating. But still shop around, make them a bit more accountable, and try and get the best deals. So, getting back to self-employed, what that means. So essentially, I've explained to you in the past how borrowing works. There's two things the banks care about: how much cash you're putting towards whatever it is you happen to be using the money for. If you're, say, borrowing to buy a property, let's say it's a residential property and your own property, then they're going to lend you sort of up to 80% without paying something called mortgage insurance, which is an insurance to cover them. But if you pay mortgage insurance, they'll lend you up to 95%. If you're buying a commercial property, they might lend you a lot less, say 60% or 70%, which means you have to kick in the 30% or the 40%, which you need cash from somewhere to go towards that. So you might be able to refinance your existing house to go towards that, or you just need cash from somewhere else. And obviously, if it's a commercial property and it's, let's say, $500,000, then if you need 30% of that, that's some serious cash you've got to be able to have as far as in your bank account. So you're going to have to probably refinance your house or try and get some money from somewhere else to try and cover that shortfall. So likewise, if you're going to borrow for money for just investing in your business, the bank would look at that as even more risky, and they'll probably lend you even less money, maybe 50% or even less of the money, which means you need 50% of your own cash or more to try and go towards, if it's to purchase stock or a whole pile of different options as far as business goes. So that's the first thing to understand. If you're borrowing for business purposes, you're going to be able to borrow a lot less as a percentage wise than if you were buying a residential property. So my advice to you, if you need some money for your business, probably look at refinancing your house as a residential loan first, because you'll be able to borrow a lot more money than you otherwise would. And then the other thing to consider as far as borrowing money, that's called your contribution towards the loan. The second thing is what's called serviceability. That's your ability to repay the loan. So if you just had a day job, they would look at you a lot more secure, because you have income coming in each week. Whereas, and it's quite consistent, and you get holiday pay and sick pay, and it's all quite reliable. But, whereas if you're self-employed, and you're what's called a subcontractor, you have consistent income because you have one employer, but what you don't have is you don't have sick days or holiday pay, and so there's a degree of risk as well as associated with that, and so they might not look at you as quite so favourable as if you had a normal full-time job. The other type of thing is if you're actually running a business where you have lots of different customers and your income's quite variable, so then they'll be looking at you with a lot more concern than they otherwise would if you were a full-time employed or a subcontractor. And in that case, they'll want to see a history of income and very consistent income generally it's over 2 years. So they want to see your tax returns over the last two years, and your group certificates, and not group certificates, but your tax returns and your financial statements over the last 2 years, just to sort of see that your income is really consistent. If your income's not consistent, so you earned a lot more money in 1 year than it was in the other, sometimes what they'll do is take the average of the 2 years, or some lenders will actually take the lowest income out of those 2 years. Or other lenders will actually take, the most recent year. And so that's why it's really important to shop around between the lenders. And again, probably a mortgage broker is best to try and flesh out all those options, because that's the thing about borrowing money as a self-employed person, is it is a lot more complex, and the banks will ask a lot more questions, and they'll have a lot higher criteria on what they're willing to lend you. And so you actually find their what's called a serviceability calculator. Their determination of what you can afford to spend will be a lot more difficult, and they'll make it a lot harder for you to borrow money as a self-employed person than they would as if you were full-time employed, just because they purely look at it as a lot more risky than they otherwise would. So you might find they'll lend you less money because of how much cash you're putting towards it, and they'll also lend you less money based on the unreliability of your income too. So So you probably find it's going to be a lot more difficult for you to borrow money if you were self-employed than you otherwise were. So again, that's why it's really important to shop around between the lenders. The other thing to consider if you're self-employed too is perhaps if you don't necessarily want to go to the banks and say, hey, I want to borrow this money to put towards my business, maybe you go and actually look at refinancing your house. Because the benefit of refinancing your house, particularly if it's like a line of credit or a redraw, what they call it, pulling money out of your house, you can refinance that up to, generally the maximum is 80%, sometimes up to 85%. And if you can pull that money out, they won't actually ask you too many questions. So what that means is, let's say you've only got a loan of say 50% of the borrowing of your house, you refinance up to 80%. You'll be able to pull that cash out and put it towards your business, and the banks won't be too concerned so much because they know you've got the security of a residential property. If you don't own a residential property, or you don't, or you've already maxed out your borrowing on that, it is going to be quite hard for you to borrow money from the banks. And that's when you start to, instead of paying residential home loan rates, which are quite low, you end up paying commercial rates, which is going to be a lot more expensive. And again, they're going to make you jump through a lot more hoops. So my advice, number one thing is just try and borrow under residential rates if you can. Try and show your income is as consistent as possible. And if you're finding you're struggling to borrow money, probably the key is to sort of plan for it. This is a thing about borrowing money from banks. If you don't need the money, that's probably when they're going to lend it to you. And when you need the money, that's when they're probably not going to lend it to you. So what you really want to do is think a bit more long term. If there's a situation where you don't really need the money right now, now's the time to refinance your loan, pull some money out. You don't actually have to pull the money out and spend it. You can actually refinance your loan and leave the money against that property essentially. So let's say you've got a 50% loan from the banks. You can actually go to the banks, refinance up to 80%. That 20% you refinance, you don't actually have to pull it out. You can actually leave it against your property, which means essentially, as far as the bank's concerned, they're only charging you interest on the 50% of the loan, but you've already had approval for the 80%. So that means if you ever need to pull that money out, you don't have to go back to the banks and ask them whether you can borrow the money, because 9 times out of 10, when you need the money is when they're not going to give it to you. So my advice to you, if you're self-employed, you've got a business, go to the bank now while you don't need the money, refinance, get the maximum amount of borrowing capacity you possibly can, and leave it just sitting there. Put it against what's called like an offset account, or just leave it against the loan so you're not getting charged interest on it. But have it sitting there so if you need the money, you can pull it out in a rainy day. So just gives you that safety net. If you don't need it, that's fine. It doesn't cost you any money, so it's all good. But if you do need it, it's just got it there and you can pull it out. And you can sort of use that. In the old days, people for their own businesses, they used to use something called like an overdraft. It's sort of a little bit gone out nowadays. People would rather than borrow against an asset because the interest rate is going to be so much lower and it's going to be a lot less questions as far as the banks go. So generally that's what people now do. They refinance their loan, that's called like a loan of credit, or they have an offset account of that money sitting in there, and then they'll be able to draw upon that whenever they need it, whenever it's there for a rainy day. So hopefully that's made sense to you, and hopefully you'll take my advice and prepare yourself for the future if you're running your own business, so you've got a bit of a safety net. So if you ever do need the money, you won't get yourself into trouble, and hopefully then you won't have to pay crazy commercial rates. So just understand, banks aren't necessarily there for you. They're obviously there for their shareholders and there to make lots of profits. And so when you need them, they're not going to be there for you. So my advice to you is, take advantage of the opportunity when you can, and because it might not be there when you need it. So hopefully that's made sense. And if you're a small business owner, you've probably experienced this before, and it'll probably make total sense to you. So if you've liked what I had to say, then click on the like button. If you haven't liked it, still click on the like button because I really appreciate it. And if you've had an experience with a bank, if you're a small business owner and you're probably relating to what I have to say, then I'd love to hear your experiences. And if you've got something else you'd like me to talk about in a future episode, then click on the comment box. I'm happy to chat about anything you want to talk about. Hey Mark, thanks for joining me, and thanks Mike, and I appreciate your time, and I look forward to talking to you again next time. Have a good day. Bye.